Hello, everybody. Welcome. This is the Statement of Cash Flows Part 6. This is a more advanced question. This is my third example of an advanced question. Once we go through and do this, I'm going to move on to a different type of cash flow problem, which is going to be fill in the blank. So just really quickly, my disclaimer and copyright notice: the information and opinions in this presentation are those of myself and not my authors, employers, or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. Presentation is copyright 2008 to 2023 by Bennett Tchaikovsky. All my rights are reserved. Any distribution without my prior authorization is prohibited. So we're now at part 6. And remember, when we're going through and doing this, this is my fifth example now. Follow these steps. Use the skeleton, set it up first, right? Show we know what the answer is going to be through the change in cash. We're then going to create T accounts for all the different accounts and put in the balances. We're going to deal with that additional information first. We're then going to reconcile all of the T accounts so that they balance. We're going to check to make sure that the large T account is balanced, and then we're going to prepare the statement of cash flows. So let's go to our next question, which is right over here, which is Bruin Sybil, one of my former students, Sybil. She did not have the best experience taking accounting classes at a place where the mascot is a Bruin. I'll leave it at that. So first thing we're going to go through and do is we're going to go ahead and make our skeleton for this company. This company's cash went up by $1 million. So we know that at the end of the day, right, the total increase in cash is going to be 1 million. My beginning cash balance was 500,000. So my ending cash balance is going to be 1.5 million. That's what we're trying to go through and prove as we do these questions. So we got BSI, statement of cash flows for the year ended 12/31/21. We're going to have cash flows from operating activities, net cash blank, operating activities, cash flows from investing activities, net cash blank, investing activities. We're going to have cash flows from financing activities, net cash blank, financing activities. Okay, so we've got that part out of the way. We're now going to go through and we're going to do our next step, which is going to go through and to create T accounts for the balance sheet accounts. And we're going to start putting in the numbers into these accounts. Okay. In our cash T account, we're going to put operating. We're then going to have investing. And we're going to have financing. Right. Remember, those are the three sections we're dealing with. And we're going to go ahead and put in for accounts receivable, beginning is 300, ending is 400. Inventory beginning is 100, ending is 25. Prepaid expenses beginning is 50, ending is 25. Short-term investments opening is 100, ending is 75. Land opening was 100, ending is 75. Equipment opening is 400, ending is 500. Accumulated depreciation on equipment is 150. Remember, this is a contra-asset account. When we have a contra-asset account, what we're going to be going through and doing is we're going to have, hold on. When we have a contra-asset account, what we're going to have to go through and do is, because as we all remember from what I've shown you before in the past, is that when we have right, assets typically have a debit balance, or increase with debits, decrease with credits. This is where we accumulate our depreciation. You see it has a negative balance on the balance sheet. So we're going to go over here and show this over here as a accumulated depreciation on equipment started at 100, ended at 150. Goodwill. This is an asset. It's going to have a balance of 500 down to 400. Accounts payable. Accounts payable is a liability. So it's going to have over here, opening of 250, ending of 100. Accrued liabilities, opening of 250, ending of 400. Unearned revenue, opening of 175, ending of 100. Bonds payable, opening of 0, ending of 500. Discount on bonds payable, it's a negative amount in the liability section. This is going to have a debit balance right over here. Common stock par, opening 1, ending of 1. Additional paid in capital common stock, opening of 199,999, ending of 499,999. Retained earnings, opening of 1,075,000, ending of 1,275,000. So I've gone through and I've done the second step right over here is to reconcile, to deal with to create the T accounts. We don't want to jump ahead. We've created those T accounts for all of our balance sheet accounts. The next thing I'm going to go through and do is I'm going to go ahead and deal with the additional information first. Always what I want to go through and do first. So we had net income of 400,000 for the year. Where does net income go? Right. Well, remember, net income, it's part of the statement of retained earnings. It's how our income statement and our balance sheet match up. The statement of retained earnings is our beginning retained earnings plus our net income or minus our net loss, less our dividends, is going to give us our ending retained earnings. So remember, what we're trying to kind of go through and do is to get all these accounts over here to balance, and then we'll get our cash flow to flow. So over here, we had net income of 400,000. I do the opposite to cash, right? So I'm going to debit cash. I'm going to do that in the operating section. I'm going to call this net income because that's what it is. So really, when we're going through and doing this, I've shown this example before. We're using net earnings. That's what we start with. And then we're reconciling to net cash provided by operating activities. That's how we do things in the indirect method. So we have over here the 400,000 of retained earnings. We've dealt with this one. I'm going to actually kind of go through and skip to number 5 because it's in the same account. So in number 5, I declared a dividend of 200,000 to my shareholders. Date of record, and the dividend was paid during the year. When I have a dividend, that's something that decreases my retained earnings. So I'm going to show this over here of 200,000. Where do dividends go? Well, if we kind of remember from what we were talking about before, it's part of financing activities. Financing, buying or selling my own stock, buying or selling my own bonds, paying cash dividends. So over here, I'm going to do the opposite to cash, or 200,000, and we're going to call this a payment of a dividend. And that's going to be for item 5, right? So over here, doing the opposite to cash. Let's go back over here and take a look at the next one. So on May 31st, 2021, equipment costing 100,000 that had accumulated depreciation of 50 was sold for 70,000 cash. Whenever we have a sale of equipment, this is a very, very important journal entry, which is right here. What we want to go through and do is we're going to create this journal entry. It's going to help us determine if we have a gain or loss, and then we're going to put it into the T accounts. The accumulated depreciation or the equipment's going to go into the T accounts for those respective accounts. The cash we receive goes into investing. The lost goes into operating as a debit. The gain goes in operating as a credit. Okay, so let's go through and take a look at this. So what's my entry? So right over here, I have my journal entry to record the sale of equipment. The equipment cost me 100,000. Okay. Had accumulated depreciation of 50,000, and I sold it for 70,000. This equipment had a net book value What's net book value? It's equipment minus accumulated depreciation on equipment of 50. I sold it for more than it was worth on my books. I have a gain of 20,000. Let's go through and put this into the T accounts. So what I'm going to go ahead and do is that the cash, let's do the equipment first. So the equipment right over here, this is going to be a credit, but this is a green. The accumulated depreciation on the equipment will show over here as a debit for 50,000. The sale of equipment is going to show as a debit over here in the investing section. That's where the cash proceeds go. Because I have a gain, the gain is going to show as a credit in the operating section. Why is it like this? Well, the gain is already included in net income, and the sale of equipment already kind of includes that gain. So that's why I have to go through and reverse it out, so it's not as to double count it. So over here, gain on sale of equipment. You do not need to understand that explanation I just gave. Just understand if you do the journal entry and you post it like this, you're going to be in business. So over here, Bruin Sybil sold shares of common stock for 300,000 cash. When I sell common stock, I'm debiting cash, crediting common stock at par, crediting additional paid in capital common stock. Well, over here, the common stock at par didn't change. So this must have all gone to additional paid in capital common stock. Where does this go? I'm going to do the opposite to cash. I'm going to call it what it is, sale of stock. I do not call this an increase in additional paid in capital in common stock. Very, very important not to do that. Okay. The last one here is I issued bonds with a face value of 500,000 and a stated interest rate of 5% for a $25,000 discount, yielding proceeds of 475. So whenever we have a bond issuance, the bond payable is always going to be shown at the face value. The amount of cash I received is 475,000. How do I know? It's told me right over here. So that means this bond was issued at a discount or less than face value. So what we're going to do with this particular transaction is we're now going to go ahead and we're going to put this directly into the T accounts. So the bond payable right over here, this is going to show an increase of 500,000 over here. The discount on bond payable is going to be a debit for 25,000. Now, I do not want to go over here and say 525. I'm just going to call this bond issuance or sale of bonds. Call it proceeds from bond issuance. And the cash I receive from this bond is 475, or the net amount of these two accounts. So over here, I have now gone through and I have dealt with all of my additional information. So let's just go through and do a quick recap. What have we done so far? Well, the first thing we did is we did our skeleton, and I forgot to put it down here, non-cash transactions. Can't forget that. So I've got my non-cash transactions. I know that my total increase in cash is going to be $1 million. So that's what I'm trying to go through and to figure out. Okay, so hide these. So coming right back over here, when I'm looking at this particular, the next thing I went through and did the skeleton. I then came up with my T accounts, right? When I did this, I made my big cash T account, my other individual T accounts, and I put in the amounts. I then went through and dealt with the additional information first, put these into the respective T accounts. And now I'm ready to go through and do my next step, which is to reconcile the T accounts so that they all balance. So over here, remember, When we have assets, typically have debit balances. They're increase with debits, decrease with credits. Liabilities and equity typically have credit balances, increase with debits, increase with credits, decrease with debits. Okay, so accounts receivable. How do I get from 300 to 400? I'm going to do the opposite to cash. I'm going to credit cash for 100. The way I describe it is in terms of what's going on in the T account. This is going to be an increase in accounts receivable. Inventory went from 100 to 25. Therefore, I'm going to need a debit of 75,000. My inventory, a decrease in inventory. Prepaid expenses went from 50 to 25. To balance it, I need a credit of 25. I do the opposite to cash. Excuse me. I'm going to debit cash, not credit cash. Debit cash over here. This is going to be a decrease in prepaid expenses. Short-term investments went from 100 to 75. Land went from 100 to 75. So I'm going to basically over here under investing, I'm going to go ahead and debit short-term investments. It's going to be debit cash for the short-term investments. We'll call this a sale of short-term investments. This is going to be called a sale of land for 25,000. Over here, in terms of the next one, sale of land 25. Okay, for the equipment, I had 400,000. I sold 100,000 of equipment, but I have over here 500 to balance. I'm going to need 200,000. This 200,000 right over here. This is going to be a credit to cash in the investing section. Remember, investing, buy or sell my own property, plant and equipment, short-term investments, land. Okay, so over here, this is going to be a purchase of equipment. Very important. Accumulated depreciation on the equipment went from 100. I sold equipment having 50. Now it's at 150. To make this account balance, I'm going to need a credit for 100. What do I go through and call this? If I remember over here, when I have, very important, when I'm increasing accumulated depreciation on equipment, this is depreciation expense. So coming over here, okay, now this next one over here is Goodwill. Let's kind of think about this. Over here for Goodwill, to get from 500 to 400, I would need a credit for 100. With Goodwill, I never amortize it. Goodwill comes about when I buy a business. It's the excess between the purchase price and the fair market value of the assets. That's what Goodwill is. Goodwill is going to go over here into our operating section. But when I do this, I'm going to have to call it impairment of Goodwill. Because as of right now, we do not amortize Goodwill. Rather, we go through and we impair it. It's going to go into the operating section. If you're taking my financial accounting class, I do not believe I put that on the final exam. However, for those of you who are out there looking at this, it may help you with something. Okay. Accounts payable going from 250 to 100. Over here, to get that, I need 150. I'm going to do the opposite to cash. My accounts payable, it's with debited. It's a debit to accounts payable. It means my liability decreased. So this is going to be a decrease in accounts payable. My accrued liabilities went up by 150,000. So I'm going to go ahead and do the opposite to cash. So this is going to be an increase in accrued liabilities. My unearned revenues went down by 75,000. Remember, it's a liability, right? We decrease liabilities with a debit. I do the opposite to cash. This is going to be a decrease in unearned revenue. My bonds payable is balanced. My discount on bonds payable is balanced. My common stock over here is balanced. My retained earnings is also balanced. So we should be good to go. But now we're going to go through and check our work. So I come over here to operating. Remember, what am I aiming for? My cash went up by $1 million. That's what I'm trying to go through and prove. So over here, we have total debits of $850, total credits of $345. My net cash, because the amount is going to be, I subtract the smaller from the larger value. My net cash provided by operating activities is going to be 505. Over here, for my investing activities, I had sale of equipment, sale of stock. Uh-oh, wait a second. Yikes, I totally put this in the wrong place. Wow, okay. Tchaikovsky, you're losing it right now. I probably need to stop in a second. So sale of stock, this should go into financing. The bond payables should go right over here into cash, right? So this stuff here, so sale of equipment is fine, sale of stock, no, sale of bonds, no, short-term investments and land, that's okay, right? We all make mistakes here, and I'm glad I made one, right? So over here, just had them in the wrong place. Okay, so over here, so this will be net cash used in investing activities. Remember, when we're going through and doing this, right, investing, buying or selling our own equipment, assuming buying or selling equipment, I purchase a business, sell a business, short-term investments, and then the other ones, I just put it in the wrong place. Okay, so over here, I've got 775, 200. So my net cash provided by financing activities is going to be 575. So what I need to now go through and do is to make sure that these three items, right? I've got operating, investing, financing. My operating was a debit of 505. My investing was a credit of 80. My financing was a credit of 575, a debit of 575. So the net amount right over here, 1,080,000, subtract the smaller from the larger balance, I get to the million. Wow, fun stuff. Okay, so that's how we go through and do this. The very last step is to go through and to prepare the statement itself. If we have gone through and if we've kind of taken the time to basically do this part, we should be in very, very good shape. So let's go ahead and hide this part. Okay. If it's a debit, we're going to show it as a positive amount. If it's a credit, we show it as a negative amount. So over here, we got net income. Okay, so this is going to be positive. This is going to be negative. And this over here. And this should equal to 505. And it does. Okay. Okay. So next one is going to be my investing activities. So I have cash flows from investing activities. We have sale of equipment, sale of short-term investments, sale of land, purchase of equipment. If it is a debit, it's going to show as a positive amount. If it is a credit, it will show up as a negative amount. So my net cash used in investing activities, when I add all this up over here, is going to be to 80,000. I'm kind of going through this really quickly. And the reason is because at this point, you're just basically translating from the T accounts. So if your T accounts are good, you should be good for this particular question. So my net cash flows from financing activities. I've got the payment of a dividend, sale of stock, sale of bonds, and hopefully I didn't screw this one up this time. So 200, 300, and then 475. So my net cash provided by financing activities is going to be 575. Okay. So down over here, my last part, these equal up to my total change in cash. So I'm gone through and I'm done with this particular question. So for this particular one, I like the fact that I included, you've got another bond being issued. You got some equipment happening here. I don't think on my final exam, I have Goodwill impairment, at least not for my accounting 1A class. That's at IVC, as we met that IVC this fall, 2023. But this should hopefully help you with going through and solving these questions. If you need me to do any other videos, I want to thank you again for watching. Please don't forget to like and subscribe, and I look forward to seeing you on future videos. Have a great day.